All right, in today's video, I'm going to be explaining CRT with ICC. I'm going to help you understand how you can find good levels on where you should enter at, or good levels where you can enter and where you can set your TPs at in the market. I'm going to also show you how I use CRT in order to try to figure out what way the market is going or the next direction that could potentially head to. So currently looking at NQ right now, and looking at it, the market has closed, but we closed off at a good CRT level that I would have potentially, if I was to take in this trade, I would have took a quick short around this area. I'm gonna get into why I would have taken a short. All right, so first breaking off what CRT is. CRT is candle range theory, and the way how we use it is like this, right? So the first thing we do is we'll come to the charts and we'll just overall look at the market, right? What we're necessarily looking for, we're looking for where price has made a big push to the downside, like right here, or where price has made a big push to the upside, like right here. But you also have another big push to the downside right here as well. You see sellers stepped in right here because we couldn't go above higher no more. So we made a big push to the downside, right? So CRT is this, or you can look at it as supply and demand, whichever one helps you really just understand better. So what we'll do is we'll take and we'll mark out the previous candle before price had made a big push to the downside. Right now I'm on the 2-hour time frame, so higher time frames will help you find these spots in the market way more easier than the smaller time frames. So I do recommend using the higher time frame. Any time frame, 30 minute, 30 minute or higher can help you find these locations in the market. So back on the 2-hour time frame, you can see that this was the last bullish candle that we had before price made this big, huge move to the downside right here, right? So what I would do normally is I will mark out the bullish opening. Remember, bullish candles, they open at the bottom and they close at the top. So I will mark out my bullish opening right here, and I will wait for price to tap into this range, right? You can see that the selling pressure right here was so strong that a candle couldn't even come into this area right here. Only thing that we did was wick off of this area. So this wick in this instance would have been my entry. Around here, this would have been my entry. I would have set my entry right up under here. I would went for a sell limit, set my entry right up under this um rejection, where that rejection wick at, right with my white line at. I would set it right at this bullish opening. My stop loss would have been a little bit above these candle, this bullish opening close. I mean, not bullish opening close, but it would have been above this bullish close and this bearish opening. That's what my stop loss would have been, and my TP level would have been at the next level of buyers. So right now, I'm gonna go to the smaller time frames, and I'm gonna show you where my TP level would have been. Right. So let's see. Let's say right. You got into this trade. You can see that price came up. We tapped that area where I was talking about. A little bit of drawdown, little really no drawdown. And my next level would have been right here. Normally I enter on minis, or if I'm entering micros, I'll probably go a little bit heavy on the micros. But the reason why this area right here in particular is my TP level is because you can see that the same thing. This CRT is the same thing on any time frame, no matter the time frame. So what I did right here basically is on a 5-minute time frame, you can see that we had this bearish candle opening right here, because bearish candles, they open at the top and they close at the bottom. But you can see that when price came down here after they got done closing, buyers ended up picking back up, and we went for a little small bull run, right? I used this area right here because this is the previous spot that price was at before it made a decent move to the upside. So this would have been my TP level. As you can see, price came back up. It tagged into my entry, and then we came right back down to the previous spot where buyers previously were. You got to remember one thing: buyers are always going to go to sellers, and sellers are always going to go back to buyers. Just like right here, buyers came, they went to sellers, higher time frame. Because on 2 hour time frame, I just showed you that this was a range where the sellers were sitting. And so where we went after we tapped sellers and we couldn't go any higher, we went right back down to buyers because this is where the buyers previously were before it made this initial big push back to the upside. That's all CRT is. But depending on if you get in like on a higher time frame, if you use higher time frame levels, you will get better entries. Now let's say price didn't stop right here, right? Sometimes it doesn't stop at the bullish opening. That's okay. The whole point of the range theory is that it can either, the way how I see it, the whole point of the range theory is that we can either get a stop right here or price can come up some more and do what you call a liquidity sweep. It's just a sweep of money. Would it came up some more, we could have swept this money, all this liquidity up here, fill these orders, then we could have sold down. So if it goes above this bullish candle opening, something that I started looking at more is that price would normally go to the opening range of a bearish candle because this is the last spot that sellers was at right here before it took this spot, this whole downside move right here. So if it pushes above a bullish candle opening, just look at the bearish candle opening. Sometimes you'll get a rejection that you're looking for in that area. So let's say, let me see. And it's the same thing for bullish. If we was trying to look for buys. So let's say that I'm trying to look for a buy, right? We had all this selling momentum down right here, right? And this is the same 2 hour time frame. Let's say I was trying to look for buys. It's Sunday, right? You can see that right here. We had a big move to the upside. This is the last spot on the higher time frame in this particular area where price was at before we made this big push to the upside. We made this big push to the upside, and then what happened? We started to sell. You can see Sunday right here, this wick ended up coming back down to where buyers are sitting. Hold on, let's see. We can probably see it a little bit more clear on 4 hour time frame, which you can. You can see buyers came back down. Sellers came back down exactly where buyers are sitting at. Same way how I told y'all, you use the last previous candle over here. You use the previous candle, the bullish candle for your entry. You'll do the same thing for if you was looking for buys. So let's say I would have opened the charts. I would have seen that price on Sunday tagged a buyer's level. This is a good level. Only thing different here is instead of using a bullish candle, I'm using a bearish candle opening. So if you're trying to look for a bullish move to the upside, you will look for a bearish candle, a previous bearish candle, or you would just look for the what's the word I'm looking for? Or you would just look for the opening range of a bullish candle if we was to come down some more. So let's say this wick didn't stop right here at this bearish opening. Expect it to come down to this bullish candle opening right here. Just like how this candle did right here. You see this bearish candle? Just how this candle came back down to this bullish range right here. And we bought up. Expect it to either do the same thing or expect it to just stop in this range of this bearish candle opening. But you can see that it respected the bearish candle opening. And soon as it respected it, we bought up. So I'm more of a swing trader, right? So I like to hold my trades for hours, and I'm trying to get into holding it for days. So something that I probably would have did if I had my live account at the moment, my TP would have been this level right here. Why? Because this is the last previous spot where sellers was at on a higher time frame before price made a big move to the downside. You see that? The same thing. So you'll base your TP points based off of the exact same thing. You'll just look at it as a seller's point of view. You see what I'm saying? And you'll base your stop loss off the same thing as well. Go to the smaller time frame and put it a little bit under those candle closures on the smaller time frame. There's been plenty of trades where we've been in trades like this and we got TP rants. Also, this is basically how we use this is basically how we enter our trades. We don't too much enter our trades based off of ICC, but we do use ICC in order to figure out what phase the market is in overall. So let's say if you were trading ICC, you'll probably mark out your buyers a little bit, something like this, right? Because you got buyers support level right here previously that was holding. So you probably, once price broke that support level on just using normal ICC, you would have used this move here as your indication. This whole move right here, you would use this leg as your indication because this indicated to you that price can sell up under this level. But at the same time, you can always use CRT to figure out where potentially it could stop at, right? So it's a level down here at like around 171. I just don't have it marked. It's a level around here where buyers were sitting that when price was selling down, I already had a picture on where price could sell down to because CRT. We had a big strong push right here. And only thing price did was these buyers right here and these buyers right here didn't hold. So the next level of buyers that we have is either right here. And if these buyers don't hold, the next level of buyers is right here. That's all CRT is. It just helps me find exactly where I can find buyers and sellers that easily. So let's say that NQ hold this bullish formation that is in right here, right? Let's say NQ hold this whole bullish structure that is in. And we make an indication above these sellers right here, right? The next level of sellers that we could go to is right here. Why? Because this is the previous spot that price was at in this area where it made a strong move to the downside. It did it twice already. We sold right here. It corrected because we tapped into buyers again. Same thing. We tapped into buyers again. It corrected, came back up, right back to these sellers, and it sold off again. Buyers are going to go to sellers, and sellers are going to go right back to buyers. It's the same thing. That's all market does. Now, let's say, like I said, let's say we make an indication above these sellers right here. The next point that we can go to is 929. Why? Because that is the CRT range on where price was at before it made this move to the downside. That's basically how we use candle range theory. This is how FSO uses candle range theory. You can see it on any time frame. Don't matter the time frame, 15-minute, 5-minute, 1 minute, 30-second. It really don't matter. Let's say price it wants to correct because we got above sellers right here on the smaller time frame, right? So let's say once price open, it could potentially either buy right here. These buyers could hold right here. But if they don't hold, guess what? And this is just me looking at a 15-minute time frame. Let's say these buyers don't hold right here, right? The next spot that we can go to where buyers are actively sitting is right here. We can look for these buyers to hold at 215. We can look for these buyers to hold at 151 if these buyers don't hold. But let's say that let's say the opening range of this bearish candle doesn't hold, then guess what? We still got this bullish opening right here. Price can still potentially just come back down to this bullish opening right here and just continue this bullish formation back up to the upside. But if we don't hold right here, then it'll just go to the next level of buyers. So that's where you'll wait, and you'll wait patiently and see what type of reaction you have at these levels. If that buying pressure starts to slow down, or you start to get some rejections like this, these are good wicks. It's showing you that, hey, we don't want to go higher right here. So of course we're just gonna sell back down. Even this, me looking at a 3 minute. Even when we sold back down, price sold down here, but we didn't close down here. Price came back up, corrected, sold down a little bit, but guess what happened? Buyers at 346 ended up holding. We got back above 346. Same thing, CRT range. We got back above 346. And once we was back above this level, we flipped back bullish because we was already bullish at this level before. So what we did, we bought up and we bought above these sellers. That's little. That's just what counter range theory is. Um, I might end it up. I'm sorry. I might end up hosting a class tomorrow. If I do, you'll see the class link, and I'll go over it some more. Also, we're gonna start doing some one-on-one sessions, and I'll do one-on-one sessions with you guys to just clear up some more stuff. All of it is free. We're not gonna charge you, and that's really about it. If you need some help, just add me inside of the Discord, and I'll just go over it again. I don't mind clearing it up. Thank you.